Okay, let's pull up the chart for AT&T, and let's look at the actual what it's doing recently. So it's started a little uptrend here. You see it's making higher highs and higher lows, and it's overbought right now. So you can see the low from last October, October last year, is right around where it's trading right now. So in 1 year, it went up and down in basically nowhere. It's around 5%.
While paying spectacular dividends.
Yes, indeed. Yes, indeed. They actually reaffirmed their guidance recently, which probably helped the stock. They reaffirmed that they'd be their guidance. So forward guidance is more important than the current results. So if you beat the earnings and you have bad forward guidance, the stock goes down. But they actually had good guidance. It's kind of hard. I mean, they have a very tough environment. The telecom companies, they have a very competitive environment. Everyone's giving away phones, trying to get people to commit to their platform. Let's look at the news for AT&T. See why they're going to release their earnings estimates. The earnings report October 19th. So we'll keep an eye out on that. Let's see. Okay, we do have a catalyst for AT&T. The iPhone 15 is coming out. They have ads, I know right now. They say, well, get your iPhone, the new iPhone, and that will get people to come to their platform. But T-Mobile and Verizon also have that same ad. Let me see. Hefty promotions. Yeah, so this is excellent advertising for Apple. So that's, let me see, breaking down. Let me see. I don't see any real reason why it would jump up like that. Let's look at the stochastics. Right now, it's stuck. AT&T is basically stuck in a range. It's going up and down, but not going anywhere. I don't expect it to go outside of this range for the next couple of years because it doesn't really have any catalysts or earnings that are going to be super. Let's look at the communications sector. This communications services. Okay, so it's been in an uptrend since last year at this time on the communications sector, which includes a lot of companies like Facebook and Google, but they lump the telecom companies in with that. So you can see that it's been in an uptrend. It's just basically started, I don't know if this is a trend or not, but it started a downtrend. So let's see if it bounces back up to here. But that's not a good sign for that sector. Let's see what some of the other stocks in that. Let's see, T-Mobile. It's actually in a down, it's kind of sideways in a downtrend right now. So the stocks around AT&T aren't doing so great. So I don't know. Let's watch that one. I have no reason. Why do you continue to hold it, Mark? What is, other than the dividend, what is the reason that you're excited about AT&T?
We're all going back to landlines once all the cell towers are blocked by the Russians.
Oh, that's an awesome catalyst. Well, when that news story comes out, hi Matthew.
Hey Matt.
We're talking about AT&T now, and how great that company is, and it's maybe getting out of its multi-year slump. All right, so yeah, so there's a big fight among carriers right now for customers. T-Mobile is leading the charge with their ads, and they're trying to get market share also in internet. So there's 5G internet that all the carriers are providing. That could be a catalyst for the phone companies too, getting the market share from Comcast and the other cable providers. All right, so let's look at some of my notes for this meeting. Okay, so we're in we're in September, so we expected this week. These weeks here have been down 24 out of 26 the last 26 years, and it's somewhat due to like this options expiration and just the time of the year. So we didn't expect it to be that great. Next week we do have end of year window dressing. That and end of quarter window dressing. So that's the end of the quarter, and all the best performing stocks for the quarter might be bought up by the hedge funds, mutual funds to make their portfolios look better. So that's always a catalyst for the last week of the quarter. And let's look at the S&P. Let's look at the S&P right now. We're actually at the bottom of our channel. So if you mark all the bottoms for the S&P, we're basically at a bottom, and we're very close to our oversold, and we have fear in the market. So if you add all those up, it's a very good indication we're approaching a time where people are going to start buying again. So as an investor, you have to think opposite what the market's going to what the market's going to do. So what the market is doing. So in general, that's called contrary contrary. I don't know what it's called, but you do opposite of what you think the market will do. Okay, so meeting notes. Let's look some of our meeting notes. S&P is down a lot since last week, 4%. And it's losing momentum. So we have these 200-day moving average links on our meeting notes. It was 37% last week for the 50-day moving average, and now it's 18%. So these are percentage of the S&P above the 50-day moving average. So we are definitely losing momentum. And whenever we get to a point where it's below 50% for the 50-day moving average, that means we're kind of we can't count on momentum to help the stock market. The Fed had a meeting this week, and they basically said they're going to raise rates probably more this year, maybe one in November, maybe a little bit more in December. But that is bad for the stock market because we have that theme: the higher the rates go, the worse it is for stocks. So that also affected the 2-year and the 10-year. And our simple formula was as the 2-year and 10-year go up, they're up 3% and 2%. So the stock market goes down with that. So anyways, we lost 4% in the stock market since last week. And we do have a light at the end of the tunnel, like maybe at the end of this year, the interest rates will be done rising by the Fed. And we're still in seasonally the worst time of the year. What else? U.S. dollar is continuing to go up, strengthen, and that's better. That's not that great for stocks. Okay, so we get these hints along the way what's happening, but seems like the interest rates have a lot to do with, and the Fed has a lot to do with the premium people pay for stocks. All right, we're still in September, which is the worst month of the year. We're approaching next week. It'll be getting into October, which is seasonally a good time of the year. So that's why we're and then December, in November and December, we have Thanksgiving and Christmas and New Year's. So all those contribute to a better environment for stocks. All right, and so right now we're oversold in our S&P chart at the bottom of our channel. Let's hope it holds right here, and we can expect higher highs if that holds. Okay, so oil is going higher this year. So we've been saying oil is inflationary for quite a while. That's going to affect that's going to affect the Fed in raising rates. So as oil continues to stay high, inflation goes high because all prices basically are affected by the price of oil, because oil is involved in every product that's sold in America. whether it be driving to deliver things or the cost of services like flying to somewhere. So right now, let's watch this. If it goes higher, then the Fed will have to most likely raise rates higher. Inflation is currently at 3.67%. I think the Fed is targeting an inflation rate of 2 point something. So we're still a little bit high. Let me see. Dollar index keeps on going up. It went up just a little bit, less than 1% this week, but it's still, the chart is going higher. And there's nothing new in gold. It's not going anywhere. Fear and greed index, we're approaching fear. So when we get to fear and extreme fear, that's the contrary indication of buying. So it might be time to start looking to buy things. We were at neutral last week, so it's getting more and more fearful. I guess what people are fearful about mostly starting this week is the Fed raising rates. And whenever you have rising interest rates with the Fed, that raises the rates for mortgages, for consumer debt, for credit card rates, and the economy goes down. The economy is not as robust when people can't borrow or buy things like they used to. That is why, I guess, why people are fearful now. The U.S. dollar index continues to go up. There's a trend. It stopped right here, and it's starting to go up. That's not good for stocks. The VIX is starting to go up. We are starting to see fear in the market. People are starting to buy protection, and it's a contrary indicator. When it gets up to 30, then that's extreme fear, and that's the real time to start looking to buy things. We're approaching the fear in our emotional gauge. Let's see what people could be afraid of. Yes, high treasury rates. That's one thing that people are afraid of. AI stock bubble, not so much. Consumer debt, whenever rates go higher, like the Fed said they're going to raise rates higher, yes, consumers are starting to default on their credit cards and have problems where they start defaulting on their housing. And we might see a lot of bankruptcies in the consumer space. So these are all fears that people could be having that could make a capitulation eventually. Overpriced stocks. We'll look at our top U.S. market movers today to see if there's overpriced stocks, high PE ratios that are going down. That could lead away in a capitulation if we have that. We still have a downtrend in our momentum. So we've been following this number of S&P stocks, about 50-day average. That has been going down in a trend. So that's not great for market breadth. Market breadth is whenever we have momentum in the stock market allowing us to keep going up. So let's hope that this stops this downtrend and starts an uptrend. Let me see. Well, every quarter, once every 4 months, we see we get an update on Ingrid Hendershot's investments. She has a investment company called Hendershot Investments, and she basically follows the same principles that Warren Buffett does to buy stocks, and the same ones that I follow basically. It's really good to check in with what she's doing, and she gets a newsletter, and it's readily available online. So you can look at Hendershot Investments and look at her newsletter. And I just updated her top holdings. For top holdings, let's look at that just for fun. Allow. Okay. The top holdings are Berkshire Hathaway, Apple, Alphabet, Johnson & Johnson, TJX, Oracle, Microsoft, United Healthcare. These are all stocks that we've been looking at over time. We haven't looked at TJX yet, and we haven't looked at Oracle. I'm going to go through Oracle today just to see if it matches some of our criteria. As it was in the news this week, they actually bought Splunk, And did they buy Splunk? No, Cisco bought Splunk. But Oracle was in the news because they reported earnings, and they went down. So I'm going to look at that. We're also going to look at Hendershot Investments newsletter just to see some of their rationale for holding some of the stocks that they do. Okay, there was an update on her website of what she thought of the current environment. And she likes the idea of having more cash, less debt in a business that has on a balance sheet. And she likes the idea of a cash flow and not debt, no debt. And right now she said, there's a snippet from the Wall Street Journal on how rising interest rates make high-quality companies even richer. The Federal Reserve jacked up interest rates to slow the red-hot economy, and some of the biggest, most secure companies that have the opposite effect, and they're actually benefiting from the rise in interest rates. We've been saying for a while that, the big companies that we're following aren't affected that much by rising interest rates because they don't have to borrow money; they have a lot of cash. And companies that find they have more money thanks to higher interest rates raise their dividends. They invest more and will be more willing to pay up for the right staff, and that supports the economy. And they also say corporate net interest payments for all companies, not just the big ones. Net interest minus debt fell as interest rates rose. So that means corporations are actually taking advantage of higher interest rates environments, ones with a lot of cash. So I'm going to go over some of what she said in her newsletter as some of her top holdings and why. And we're going to match that to some of our theses of why we hold that. I mean, why we've been following those companies. We'll do that a little bit later. But I'm going to go through one of her stocks, one of her top holdings, number 6, Oracle. It was in the news recently. They had their earnings come out, and they basically dropped. You can see they dropped in a major way after the earnings report. And so you can see they're kind of in this sideways pattern right now. They're trying to transition from a legacy database provider to a cloud provider, and they also have AI and services revolving around database in the cloud. And they're also getting into services. So let's look at some of their numbers. I did the E-Trade consensus estimates chart on them. It doesn't seem like they're growing very much. They're growing around 11%, and their PE ratio is 32. So they're about 3 times overvalued. And I guess they sell for a premium because, it's consistent growth. We do have around 11% growth over time, and it's been consistent. So people pay a little bit more for that. But they're switching a business model right now from selling databases to selling services like cloud and selling AI offerings. And so that is not as robust. I mean, they're going in a new spot that they haven't been successful before. So that's why it's kind of shaky right now with their earnings. It's not as consistent as before. So let's look at some of the other numbers. They have market cap of 1/3 of $1 trillion. That's 300 billion. They have the forward PE is 20. Okay, so the forward PE is 20. So I guess if they're growing 11%, the PEG ratio is around 1 point something. So Yahoo thinks that their PEG ratio is 2. So Yahoo thinks they're growing around 16%. So the profit margin is really good. That's 18, and they don't show a return on equity, so that's kind of not great. So they have more cash. They have more debt than cash right now. So that shows us they most likely borrowed when interest rates were really low, and they don't need to borrow money going forward if they want to make a big acquisition. And they pay 1.4% dividend. So if you look at their total return, I guess is 13 or 14%. It's still overvalued for. I'm not sure exactly. Maybe it's a long-term hold for Ingrid. When she has it in her top 10. I see there's a lot of competition from Google, from Microsoft, for cloud, and AWS, for Amazon. It's getting very, very competitive. I don't know if they have a moat that will allow them to grow like they used to. Anyone have any ideas about Oracle and why they might have, be selling at a premium, why they're a great company? I don't hear anything. That means there's not a whole, for me, there's not a whole lot of confidence. I don't have a whole lot of confidence that they'd make that transition to be a cloud or AI offer company. Let's see.
This competition, I think, is that there's between Google and Amazon and Microsoft and then like Baidu or whatever in China. It's a tough spot to be in.
Yeah. Yeah, I agree with that. That it's just a lot of competition, and Google is throwing. I mean, they're all adding their own AI to their offerings, and not only does maybe Oracle might have like a niche on database, but to be an expert in AI whenever you're against Google, who's been doing AI for 15 years, and Microsoft, who has ChatGPT, and I don't know. It seems like a very competitive environment, and because of that, I'm not convinced that this stock will grow like they used to. We'll keep in touch with this because it is a stock that was blessed by Ingrid, and I know I trust Ingrid in her research. So we're gonna keep an eye on it. Maybe it'll drop some more and go down to maybe its PEG ratio of 1. Whenever that happens, then the numbers look a lot better. But I like to buy stocks whenever the PEG ratio is 1 or the forward projected PEG ratio is 1. But right now it's a little expensive for me. Let's look at, okay, so I gave you some links in the handout today of Hendershot Investments newsletters and her top 10 information. And let me see. Let's look at her newsletters, some of her top holdings. We're following a lot of these, like Google, Alphabet. She says free cash flow is plus 12% in Q1 and announced a buyback. So a theme in her reasons why she likes companies is free cash flow. She likes buybacks. She likes dividends and increases in dividends. That's like a theme in all of her stocks. And let's look at Apple, why she likes Apple. And this is the total return since when she bought it. So you can see some of the highest return she has been some of the biggest companies like Alphabet, Google. And this is Berkshire Hathaway. Book value increased. So I guess book value is what Warren Buffett, it's such a complicated company, Berkshire Hathaway, to understand. And Warren Buffett said the way to value the company is by the book value. And the book value is increasing. It's the only stock that I know that is looked at how successful it is by the book value. But it's increasing 6.6%, and it still has the largest shareholder equity of any U.S. company, and has a lot of cash too. So they're ready to buy, a big company when they're in distress. We were looking at Booking Holdings a couple times. This is a stock similar to Expedia that does online bookings, and their business model is kind of in jeopardy based on AI, maybe, that if AI can make a booking for you, and that will take business away from these kind of companies eventually. But she likes it because revenues grew 40% higher, and in free cash flow of almost $3 billion. So free cash flow is very important to her. Let's look at some of the other companies. Cisco was in the news this week. They bought a company called Splunk, S-P-L-U-N-K. That Splunk does kind of services for the networking world. So there's a lot of companies like Cisco that are buying companies for services so that they can have a bigger amount of profit. Because whenever you charge for services, the amount that it costs to provide those services is very small, and the amount of money you make is greater. So they have a big user base. They're trying to offer services now that'll to their customers, and that'll help their margins. And what she said, free cash flow is 44% increase year to date. But they're very expensive too. There's some other companies that she's interested in. MasterCard. She says free cash flow increased 11%. Okay, so free cash flow is another important thing for MasterCard. Meta, Facebook, and they said they repurchased $9 billion of stock. Microsoft, she said they paid $5 billion in dividends and repurchased $5 billion in stock. Okay, so we have a common theme here. She likes repurchase, free cash flow, increasing dividends, and a lot of the stocks. We'll go over some of these stocks that she likes that we're not following right now as they in future sessions, because I believe in her methodology, and she wouldn't hold something if she didn't really see a long-term reason to hold it. And she's been holding some of these. Look at these purchase dates since 2012, 11, 2010, since 1994, Berkshire Hathaway. So she is a buy and hold investor. So she likes some of the same. She basically follows everything that I'm following for how to buy a stock. But she actually has. Could you hold on for 1 second? Hold on for 1 second. Okay. All right. So let's look at some of her other companies she likes. Nike. She says paid $528 million in dividends and repurchased $1.5 billion in stock. Okay, so increasing dividends. We had a theme here, and some of the stocks that she likes that we're not following. We've looked at United Health Group a couple times, and it seems a little expensive. And we saw that the United Health Group, the whole health insurance group, is not performing very well recently. She likes Visa because they paid dividends and repurchased stock. Okay, so that's the theme for a lot of what she's. And here's another stock we're following. Pepsi. She says they plan to pay $6.7 billion in dividends and repurchase stock. Okay, so we'll go over some of these stocks in later sessions, but it's great to see some of the stocks that we're following and someone that's as smart as her also following that stock and still owns it. Okay, there's an article about a single best trade portfolio manager. This a portfolio manager says our single best trade, and he was talking about his pick of Broadcom. We've actually went through this before, and we've actually talked about Broadcom as a potential stock, that's undervalued. It's a semiconductor stock. They make their biggest customer is Apple. They make 5G devices or circuitry or elements for the iPhone. And they had there was a rumor that maybe Apple wasn't going to be buying their product anymore, and that was false. There's a lot of false rumors out there, so you have to really, really understand where your information's coming from before you buy or sell. You're based on that. So what I did was I did a search. I did a deep dive into Broadcom to see what their earnings are and if there's any potential. You can see that they have, it's pretty consistent earnings summary. It's going up in a straight line. The forward PE is 17, so that is really, really low for a semiconductor company. Their biggest customers actually are, let me see, their biggest customers, I did a Google search here. The biggest customers are Verizon, Windstream, FLIR, Frontier Communications. So they sell to the telecom industry. That's like their major customers. And Apple happens to be, you know, another customer. They make circuitry for their iPhone. But they're growing around 10% if you add up all the numbers. And they have a 2.28% dividend, which is pretty high for a semiconductor company. So that means their PEG ratio is 1.7. So that's like a bit approaching fair value, but they're only growing at 10%. So that's not that great. I did the numbers on them for their statistics, and they have a market cap of 1/3 of $1 trillion. So they're approaching a really big company to be a really big company. Their PE ratio is 17, which is really low. Their PEG ratio is 1.23 according to the Yahoo. So that means they're growing around 12% according to Yahoo. Their profit margin is great. It's 40, and their return on equity is 64. So we have all of our numbers we're looking for. They have a small amount of debt, like 20 billion, if you net the cash and the debt. And you compare that against the market cap, it's not that much. So they're near debt-free, and they have a dividend of 2.2%. So I looked at some of the top news stories on Broadcom, and this is an example of whenever a story comes out, you can't believe everything you hear, and sometimes it's right and sometimes it's wrong. And one report says Broadcom stock falls on report saying Google AI chip business is at risk. And the next day it says Google downplays reports of ditching ties with Broadcom. So you'd see a big drop in the stock price. And if we have our understandings of the multiples right, we wait for a PEG ratio of 1, and whenever the stock drops down to like maybe here or here, whenever the PEG ratio is 1, we see a consistent grower would be ready to buy that. And we see that Google actually, they said they're not ditching their ties. So that's an example of, a stock dropping on earnings. And you got to know how much of the earnings would be Google oriented. If that was the true story, you'd have to say 10% of the earnings could be affected. But in this case, it didn't have any effect on the earnings at all because it was a fake story. And so let's look at some of the catalysts, benefits, and the reasons why the stock would go up or down. There's a Chips and Science Act to bring a manufacturer of chips to America. So they might get some funding from from the taxpayer to make factories in America. They acquired VMware, and that could be helping their services part of their business. So services is very high margin. That means if you charge like $100 for something, it'll cost you maybe $1 to provide that service. So that's why it's so lucrative to offer services. And a lot of companies like Cisco, they acquired a company for services, and VMware is a service-based company. So let me see. Okay, so they also have an AI chip business. Okay, so that right now companies that have the word AI in their associated with their company, they usually sell for premium. And right now, this is a very, it doesn't sell for a premium at all. It's a PEG ratio around 1.2 to 1.7. So we have a couple catalysts, and if they have some news stories that says maybe another cloud provider is using their chips, or that could be a catalyst for it to sell at a premium like the other AI companies. All right, that was a good exercise. Let's look at Morningstar, what they're saying. They say the price to fair value is 1.3. That means they're Morningstar thinks they're 13% overvalued. So their last price is $9.22. The fair value is $8.15. And you see this $9.22, you think, whoa, that's an expensive stock. But it doesn't have anything to do with, the price of the stock has nothing to do with the actual valuation because it's all based on percentages of earnings. So if you earn a certain amount per share, that will give you your PE. And so you have to pretty much ignore the price of the stock. You have to just keep in mind all those valuation measurements we're talking about. Okay, and let's look at the CFRA report for Broadcom. It says the fair value is 12%, 13% lower than where it's trading at. So that kind of goes with our PEG ratio of 1.23 or 1.5. It's overvalued by 13%. So that's kind of a thing. Let's look at the free cash flow. This is really good. You want free cash flow to be going up in a straight line. And that's, you can see every year it increases. And let's look at the PE ratio. It's basically traded at the same PE ratio through its whole career, its whole history. So it's around 15 to 17 max PE, and then it goes down to maybe 10 PE is the lowest every year. So this is a very consistent stock. If it sells off on a bad news or something, it's you can buy a quality company that's growing and doesn't have that high of a valuation. So right now it's overpriced, but we'll wait for that. Let's look at Broadcom, the actual chart. You can see that it was up in an uptrend since the lows of the stock market last year, and it's in an uptrend. Lately, it's been in a sideways pattern right here, but I think it's gonna follow this S&P in this upward channel. So, all right, that was a good exercise. Now let's go to the stock market to see what's going on. Okay, we have. Let's look at. Okay, the S&P is basically flat for today, and okay, so the stock market isn't going anywhere today. We've had a bad week, so there's a lot of and we're near the low in stochastics. Let's look at look at the U.S. market movers for today. The ones going up the most are semiconductor stocks. We have Broadcom, the one we just talked about. We have ON Semiconductor. We have Lam Research. These are all stocks revolving around the chip making. And the ones, NXP Semiconductors too. The ones going down the most, we have the theme of, we have retail stocks in here. We have, I don't see any things in there. Okay, let's look at some of that's the S&P. Let's look at the NASDAQ. Okay, we have semiconductor stocks going up. Micron is in semiconductors. Let's look at the Enphase. Enphase is a very volatile stock. So it goes up 10%, goes down 10% regularly. Tesla is going down. Okay, we see a lot of retail stocks going up and down today, and there's a lot of whenever interest rates go up, and we had a commitment from the Fed to raise interest rates, then there's pressure on the consumer because they raise the interest rates on credit cards, and then retail companies are affected by that directly almost. So I think a lot of the retail stocks are under pressures. Dollar Tree, Ross Stores, let's see, eBay is a retail stock actually, and Walgreens. Okay, let's look at the Dow, United Health Group, Apple. Okay, so we have a flat day today, basically flat, meaning not not doing much. It's going up and down and kind of flat at the end of the day. Okay, let's look at some more of what sectors are going up and down today. All right, we have regional banking. Okay, so we know whenever interest rates go up, that affects, we had some banks fail earlier this year, Silicon Valley Bank and Signature Bank, due to interest rates going up. And their stocks, I was expecting today to have, if these regional banks are going down, I would expect regional banks to be in the top 10 of the ones going down. Let's look and see if we can see that. No, I don't see any in the top 10. Any regional banks in the top 10. All right. So as the interest rates go up, you have a lot of banks that have maybe treasuries that they bought at 1%, and they have to, if there's any run on the bank, that could cause a serious problem for liquidity. Let's see. At the bank, okay, the banks are going to be affected by that. Rise in interest rates. Select, financial select. Okay, all these three have to do with interest rates. Consumers discretionary. Whenever interest rates go up, consumers have less to spend, and we have the price of oil going up. So when the price of oil goes up, consumers spend more on gas. They have less to spend on retail. So we have the retail sector is stressed out now because of interest rates and the price of gas. Let me see. Retail. Okay, so you have the retail. So this all has to do with interest rates now. Let's look at some of the ones that are doing the best. Semiconductor. I don't know why the semis are up today. Oil services. Okay. So technology is up. Okay. Okay, home builders. All right. So that was a good little exercise to do. I don't know why the semiconductors are up. Maybe the idea that the big companies, like the big tech companies we're following, maybe they're not affected as much as the other companies, and they'll actually benefit from higher interest rates that we were just talking about. So that's the rundown for our sectors. Now, let's look at some of the other things we prepared here. Hold on. Okay, let's look at some of the stochastics for what we're following. Okay, we have. Okay, got the wrong one there. Okay, so the S&P, we're basically oversold, and we're approaching the bottom part of our channel. I think most of the stocks and indexes we're following are like that. The QQQ is the same spot. If this interest rates, if we break through these levels here, and we start going down here next week, then we're basically starting a new pattern down. So let's hope it holds there. Defense sector, defense ETF. It was sideways for a long time. It's starting to break down. Gold is sideways, and consumer discretionary is following the S&P, so it's still in an uptrend, but it's at support there. Let's look at the material. Okay, nothing there. This is an uptrend. This XLC. We were looking at it's starting to break down, like it's break out of its channel. So let's hope it doesn't break down too far. Otherwise, it'll start going lower lows and lower lows, lower highs, lower lows. Let's look at the healthcare. It's kind of sideways. This sector pays a dividend, and it's pretty consistent in good times and bad. So let's look at the industrials. That's still on an uptrend. Almost every sector is at an impasse here. But one thing that could break all these indexes through this lower channel is higher interest rates. If the stock market and the Fed combine to reduce liquidity in the stock market, and the higher interest rates happen, and there's more indication that there's going to be higher interest rates, that'll make almost every one of these charts into a downtrend. So you got to be ready for that. Okay, consumer staples. This is pretty in this range here, so it's going sideways. XLF, it's right in the middle of its chart pattern there. And you see, the energy sector is probably one of the healthiest sectors right now. And it's right in the middle, it's right at the top of its range for, I guess they have, oil is going up. So as oil goes up, this sector will be doing good. The Brazil ETF it's basically sideways. So it's not really, it's overbought right now. And uranium basically has broken out of its sideways pattern it's been in for a long time. The theme for uranium is that as clean energy is promoted around the world, the use of uranium goes up, and the demand goes up, and so the stocks around that are in the URA go up with it. So I'm not sure if there's a correlation between this and the regular stock market, but we'll see over time. Let's look at some of these stochastics for the stocks we're following. AbbVie is, almost every drug company is in a sideways pattern. Every stock that pays a dividend, and it's right in the middle of its, and it's at the high end of its range right now. Abbott is the same sideways pattern, and it's oversold. And Alibaba, it's going sideways. It's actually has a pretty good news story. They have a ability to list some of their shares on the Hong Kong exchange this week, and that was good. But that didn't really, that made the stock go up like 5% today. Alphabet is in an uptrend, and we're at a decision point. If it breaks through this lower channel, it'll go with the S&P. Right now it's overbought. So let's look at Altria. It's in a sideways pattern. This has been a pretty reliable sideways 8% dividend payer for a while, and it's oversold. I guess whenever you have turmoil in the stock market gravitates towards some of the dividend-paying stocks. Maybe that's why AT&T is going up, and because higher interest rates, that'll make a lot of the high PE stocks in the stock market, the S&P, go down or not go up as much. And a lot of times the interest rate, the tech stocks, the stock market in general goes down, and the interest-paying, dividend-paying stocks that are more conservative go up or stay where they're at. So let's look at Amazon. Amazon has been in an uptrend. One thing I noticed this week about Amazon is they had a news story that came out about how much of their business is advertising. So Google in their antitrust lawsuit, or that they're defending right now, they said that Amazon has a better model for advertising because they have a lot more information about their customer than Google does. So Google's they're facing a lot of pressure from Amazon. And on top of that, Amazon is starting to advertise on their Prime Video service. So they're going to start ramping up their advertising revenue. So that might be why people are excited about this stock. but they're like every other stock. They're at the bottom of their range. Let's hope it doesn't break through that, and they're oversold. Apple. Apple is broken out of their long-term, like year-long uptrend, and they're starting to go sideways to down. So that's they're actually in this pattern right now, and they had the iPhone 15 launch recently, and they had a lot of pre-orders, so that could be a catalyst for them to. And they have good news from China, so that could be good catalyst news. They're oversold right now, but they're still overvalued. AT&T. Mark said that that it's actually making a comeback, so they're more of a conservative stock that pays an 8% dividend or so, and maybe that's the kind of stock that will work in this environment. Bristol Myers, and it's in a constant downtrend, so next stop for that is down here most likely. Colgate Palmolive, it's a dividend-paying stock, and it's been going sideways for years, and it's a little bit overbought right now. CSX, it's overbought, and it's a dividend-paying stock too. It's pretty steady. And JP Morgan is in an uptrend. It seems like they're taking advantage of this environment. They just got a bank basically given to them for really expensive earlier this year, and they're doing a lot better than the competitors in this environment. And they're oversold, and they're at the bottom of their range. So let's look at Meta. Believe it or not, they're still in an uptrend. This is one of the only stocks that's continuing to go up, and they're up like 300% this year. So if they break through the bottom part of this channel, then this whole beautiful uptrend is at risk. Let's look at JP Morgan. Okay, there we looked at that. Microsoft. They're still in an uptrend. They have AI tailwinds, and they're going to start charging $30 per seat for the AI Copilot. That is really big because they have a big user base for Office. And they recently renamed their Office product Microsoft 365, so maybe they won't be perceived as a monopoly in Office. They're just offering a service. I don't know. But okay, so they have they got some good news for their regulatory buyout of a gaming company in Europe this week. So that's looking good for them, and they're diversifying the way they make money, which is very good for consistency. Pepsi it's a dividend-paying stock, and it's basically been going sideways. It's pretty reliable. And Procter & Gamble is also dividend-paying, but it's in an uptrend. Maybe it's kind of sideways if you look at it that way. Starbucks is at the bottom, and it's basically kind of starting a downtrend. It's breaking out of this channel it's been in for a while. Verizon is following AT&T. It hasn't gone up with AT&T and T-Mobile recently, so it's at the bottom end of its range. And Visa is one of the strongest stocks we're following. They're continuing to do good in good times and bad. MasterCard is very similar chart pattern. And Waste Management, dividend-paying stock that's pretty consistent. Their business isn't affected by economic cycles, it seems. Amgen is a dividend-paying drug stock, and they're at the top part of their channel, so they're most likely going to start going down this part pretty soon. And CVS is in a super downtrend. This is like one of the worst stock charts that I've seen for what we're following, and their business model is being affected by some of the competition. That one of their main businesses is charging their middleman for drugs, and that business model is being affected by competition. So I don't think Warren Buffett would be interested in CVS. And on top of that, they're a retail company, and retail companies are getting hit by the consumer not spending as much. And So they got a double whammy. And Johnson & Johnson, they seem like they're pretty consistent in their dividend-paying stock, and their Ingrid Hendershot has it as one of her top stocks, and they're raising their dividend regularly. So, in Walmart, it continues to excel and take business away from all the other retailers. So this is probably one stock that's going to be a real retail stock. Probably Amazon and Walmart are the two retail stocks that'll continue to do good. Every other one, I'm not sure about. Maybe Costco will do good. Tractor Supply is in a sideways pattern right now. And Berkshire Hathaway, it defies gravity. It continues to go up when the stock market's starting to go down. So whenever this stock sells off, I'm going to seriously look at this as a long-term position. Right now, it's like it's not going down a lot, but it'll drop if the stock market goes down a lot. Visa, this is the same chart as Visa. It's very strong. It's growing like 11-20% a year, and they still have a monopoly with Visa for worldwide transactions. And eBay is paying a small dividend, and it's pretty much not going anywhere. It's not growing. And Boeing, it has quality control problems, and they can't sell enough. They can't make enough airplanes to meet demand. So I'm not sure if that's and they're pretty inconsistent. I'm not sure if that's a good stock to buy. We'll watch that. Tesla is still in an uptrend. They have a lot of new businesses they're coming out with, and it seems like it's one of the strongest stocks we're watching. Nvidia is at the bottom end of its range. They're oversold, and we know October's coming up. Maybe if it breaks through this, that's bad, but it's a support. Nike is going down. It's one of the retail stocks that are affected by the consumer. And Ford is going sideways. It pays a dividend, and it isn't growing, so it's probably going to do this for a long time. Upstart, we're just watching it just for fun. It's an AI hype stock, and it doesn't have a whole lot of earnings to support the stock price, so we're just following it just for fun. In Fiserv, just like the S&P, it's been actually dropped a little bit below its trend lines. So now it's starting a new trend line down. Costco, it's kind of like a little uptrend, and it's because most of its money comes from user renewal fees. It's pretty stable in going up. It's not affected as much as other retailers by the consumer. And T-Mobile, it's in a downtrend, and it's starting to pay dividends. Maybe it's sideways like the other stocks in this sector, but it's basically turning into from a growth company last year to maybe sideways growth for this year. We'll see. That's the end of this session. I think I've exceeded my time. Thank you everyone for coming, and hope you have a good weekend.
Thanks, Greg.
All right.